Hi, I'm David Berkowitz, the CIO of Value Line Partners, a Red Bank, New Jersey investment advisory firm. We manage retirement accounts by giving you your own mutual fund of stocks of great companies. If you've been watching any commercial television lately, you're well aware that the financial services industry is very busy running expensive ads imploring us to worry about our retirement future. Open a new account today, they say. And today in America, your main road to retirement is an individual retirement account, IRA, or a 401k plan at your employer. And did you know that Americans entrust over $10 trillion of their retirement savings to thousands of big and small financial service providers? That's more than $100 billion in fees every year for your broker, your insurance guy, your independent advisor, and the mutual fund companies. Did you know that according to a study released by economist Robert Hilton Smith, that the median income family will pay over $150,000 over the course of a lifetime in total fees, consuming close to 1/3 of a family's investment returns? Did you know that 6 in 10 Americans have no idea how much their retirement plans are costing them? And worse than that, did you know a recent AARP study reported that 70% of retirement savers were not even aware that they were paying any fees at all? Imagine if we could keep our own money working for us by avoiding outsized Wall Street fees while still getting the high return of stocks of great companies. You don't have to imagine it. We've made it a reality. And here's what you need to know. Remember from our previous videos, Be an Owner, Not a Loaner, and Simplifying Finance, only 3 kinds of investments, that there are only 2 types of investments, rising income and fixed income, that any investor should put in their portfolio. As you can see in this table, that there are really only 2 kinds of investments, and they are rising income, and fixed income investment. That is, you can either be an owner or a loaner. The first type of loan that you can make is cash. It's a cash deposit in a bank. You can buy commercial paper or treasury bills too by making a short-term loan to the government. Bonds are also fixed income. You get interest and then you get back your principal when it matures. But these are corporate bonds or government bonds or municipal bonds. So these are loans to corporations, loans to governments, or loans to municipalities or state. Then there are stocks, which are rising income investments, and that means that their dividends and their income grow. And they are the only ones that are inflation protected, meaning that they actually earn more, or at least in history they've earned more than inflation over time. That means that you actually grow your money, your wealth, over and above inflation with only being an owner of a business, or you can own shares of those businesses called stocks. It could be public or private businesses, either one. Only ownership shares of businesses offer inflation protection and rising income. So we want to be owners and not loaners. That was the message from our first 2 videos. In most of those retirement accounts, we don't have stocks and bonds. Most have mutual funds. What is a mutual fund? It's a basket holding 20 or more investments. No one investment can be over 5% of the whole thing. Think of stocks as the best Christmas present you could ever get, and mutual funds as the often very expensive wrapper or package. The packaging is put together by people that take fees right out of our investment. And this is what your IRA and 401k accounts look like. Many packages or many mutual funds containing stocks or bonds or money market deposits. These packaged investments, known as mutual funds, flourished in the 50s, 60s, and 70s because they offered the individual investor, the little guy, ownership in a portfolio of stocks and bonds at a reasonable cost, which was previously unavailable to people with only modest amounts of money to invest. You see, the mutual fund takes in small amounts of money from small savers, pools them together, and then hires a portfolio manager to invest those bigger chunks of money in various stocks or bonds. Each one of the mutual fund investors then own a pro rata share of that portfolio. It was really the only way for individual investors to own a piece of the great companies with instant diversification, professional portfolio management, and reasonable costs. It all worked pretty well. Then it changed. When 401ks and IRAs exploded during the 80s and 90s, money in mutual funds increased exponentially, creating an $8 trillion industry by the turn of the century. Now it is over $13 trillion. In 1980, when funds had about only $130 billion, the 401k had yet to be created. But by 1990, the number of active participants in 401k plans had skyrocketed to 19 million, according to the Investment Company Institute. 5 years later, in 1995, the number of active participants in 401k plans had grown to 28 million, eclipsing the number of people with private sector pensions. From 1982 through 1999, the S&P 500 index, or the market, earned 19% per year. This bull market coincided with a massive shift away from the old corporate defined benefit plans, pension plans. When you're earning such high returns like we did in the 80s and in the 90s, very few of us noticed that we were paying 3 to 5% per year in fees in those retirement accounts. Now, what are those fees? There are three main types of fees in our retirement accounts. The first are administrative fees. These cover the cost of providing customer service, as well as other day-to-day expenses, including record keeping of our accounts, processing any transactions, distributing statements, and ensuring that we comply. The second type of fees are investment management fees, and they're applied to the expense of managing and maintaining a plan's assets. Those are the investments. These costs typically include payments to portfolio managers, investment researchers, and other employees responsible for a fund's investments. Investment management fees are typically calculated as a percentage of the assets under management and are charged by the fund manager, the mutual fund company, to manage the mutual fund's portfolio. And then a financial advisor also charges fees to cover the service of advising the client directly on choosing those mutual funds from some menu that is put forward by the plan's administrators. Financial advisors basically set the menu for the retirement plans. Now, the fund manager basically is the portfolio manager at the mutual fund company, and then the financial advisor is the person that advises the client directly on which of those mutual funds that they should have in their retirement account. And then the third type of fee are marketing fees, also known as 12B1 fees. These are the most controversial fees paid by investors. A portion of the costs are set aside to provide informational material, such as advertisements, brochures, and other promotional content. And a separate portion of marketing fees are used as payment or rebates by mutual fund companies to help get their funds placed on your employer 401k menu, and this is done by brokers and other plan administrators. As Wall Street Journal columnist Jason Zweig explained, the arrangement to Frontline in the Retirement Gamble, which was a program a couple years ago on PBS, on PBS program Frontline, a lot of people, he said, use a term like kickback because in some ways it is a kickback. It's a legal kickback, but it is a sort of you scratch my back, I'll scratch yours kind of arrangement. If you sell our funds, you will get a portion of the revenue we earn from selling them through you. So the advisor or the plan administrator will get a kickback from the mutual fund company so that if they choose their fund, they're going to get paid a big commission. That's basically what we're talking about here. So why don't we consider the cost of investing? Well, mutual funds and brokers have constructed the system so the costs are practically invisible. Of course, they don't want you to find out that there's a kickback involved. You had to write a check to pay your electric utility and your mortgage company, but you never paid with a check, a bill for brokerage commissions or mutual fund management, did you? Such costs are simply deducted right from your annual mutual fund returns or taken off the top when brokers execute your trades. You don't notice that 3 to 4% disappears when you're making money in a bull market, but how much do these fees really cost us? Let's take a look at our simple calculator tool that you can use for free at www.valueline.com/calculator. Write that address down because many of you will want to play around with this. Say we have an IRA at age 21. We deposit $5,500 a year until we are 68. We earn about 7% a year, and we invest all our dividends into the account, into the same IRA account, which means we get compound interest, which is interest on interest. And voila, we're a millionaire. We actually become a millionaire all by the age of 68. Not bad. But wait. You invest with the average mutual fund and you pay 2% more per year in costs. So at 7%, you still have $1.9 million. Great, but in insanely low compared to $3.8 million. Wall Street takes 50% of your savings compared to investing in the stocks directly, compounded interest on interest over the 45 years. That 2% may not seem like much in a given year, but over a long period of time, the impact is enormous. Here, you give up 50%. But the longer you go through retirement, you lose up to 70% of your potential returns to fees. If you're having trouble comprehending how just 2% difference between 7% and 9%, that 2% in fees can destroy nearly 2/3 of your nest egg, you're not alone. Your 401k, mutual fund manager, administrators are charging you on average about 30% per year of your expected return. And they take that money whether you make money or not, year in and year out. I repeat, 1/2 of what you could have gotten from your investments in a typical structure, in mutual funds, in your administrative accounts, in your 401ks or your IRAs, if you have mutual funds, is gone by the time you are 68 years old, taken by fund managers and 401k administrators. It is truly taxation without representation, and a reason you should rescue those old 401ks at former employees and roll them into one IRA where you can control all the costs. Don't abandon them. Control them. I leave you with this. What you're looking at is the list of the Forbes list of the 500 richest people, and you can see that these people are all mutual fund managers or sellers. Abigail and Edward Johnson are from Fidelity, and Charles and Rupert Johnson are from Templeton out in California. Charles Schwab, we know, the discount brokerage guy. He sells mutual funds. And then Mario Gabelli, also a famous mutual fund manager. These are all among the richest people in the world. So the thing that you want to understand is the richest people in the world don't invest in mutual funds. They sell them to you. And that means you shouldn't invest in them either. You should invest directly in stocks. So thank you for listening to this educational video. Visit our website at valueline.com. Email me anytime at david@valueline.com. And our phone number is 732-800-2375. Thanks again for listening.